Be a good one.
Welcome to Wise Beyond Bitcoin, where you come for education, analysis, and opportunities in blockchain and crypto. My name is Lucas.
And my name is Ryan.
And today we have what we love to do is talk about economics and markets and the Federal Reserve and monetary policy, one of our favorite topics. And if you like that kind of stuff, you know what to do. Hit the subscribe button, the notification bell, the thumbs up. If you like to understand really behind the scenes, the macro, micro fundamentals, and maybe to help give you a picture, an idea, an understanding of how you can navigate in the long run and give more stability and peace of mind in the decisions that you make when you see all of the news and all of the hoopla. That being said, this is not advice. It's not an advice of any sort, not financial advice, marital advice, legal advice, spiritual advice, medical advice, educational information, entertainment. And it's our research, our understanding, our perspectives. Did we spend an inordinate amount of time of our life reading economic journals and monetary policy? Maybe so. And if you want to benefit or help you go to sleep on that subject matter, we're here to help you, starting with maybe all this red, we're seeing a sell-off. We're gonna talk about a lot of things. We're talking about what's causing the sell-off, what's the news. And we also are gonna wrap up with giving you an understanding that's not often spoken about enough. And that's how young and early and how much of a baby that the market really is, which means how fragile it is in the short run. So we're gonna have some short run and some long run perspectives. But okay, so we're seeing some
lots of red,
7%.
That's okay, right? That's
8%, 16%, 10% in one day. This is just 9%. This is just in the last 24 hours, which, I mean, this happens in crypto and blockchain all the time. At the end of the day, $43,000 Bitcoin is over twice as a 200% return. If you would have bought Bitcoin at its peak in 2017, 18, that year, then right now, 4 years later, you would have doubled your money. And I don't know what kind of IRA or 401k or pension fund that if you ride out the wave that in 4 years you can come away. Now, if you would have done it earlier, you tripled your money at $60,000. But you know, the idea is that in the long run, we see Bitcoin, Ethereum, and these cryptos at a lot higher valuations. In the short run, we see that there's they're
very volatile
volatility where the joke, it's not even a joke, it's a joke to people who don't understand. But the idea, the meme is that Bitcoin regularly retraces 85-80% regularly before rocket shipping to the next 600 700, whatever, you know. So that the idea is that if you can, the idea of HODL didn't come from writing out 7% dips. You know, anyone can write a 7%
it came from taking a bloodbath at a 70 or 80 or 90% drop, you know.
Right.
That, and having those diamond hands and saying, well, I believe long term this is going to be a good thing, I'll stick with it.
That's it.
Well, let's jump into what's going on today, because you know, if you look across nomics or any of your favorite index, and there's a lot of red, and it doesn't seem to me too many projects escaping the sell-off. So what's going on? You might remember that we did a video on this a few weeks ago, that the Fed had a FOMC meeting in December and announced what their look on the future policy would be. And today we got more details about that meeting. This is they released the minutes, which is like all the back and forth, all the little nuances of what was being discussed in the meeting and what the different people felt, and how the breakdown was across the because there's a survey they do. And you know, we got some more details. And so this what was the takeaway here is that the Federal Reserve is a lot closer to raising interest rates, closer than anybody than we anticipated, right? And the reason why are we seeing this acceleration in their plan in the timeline for the rate hike? And it's really driven by inflation, right? So we've been seeing over the last couple months some very worrying inflation data coming out, 6, 7, 8%, per month inflation rates are, that's not really something we're comfortable with. That's a little bit higher than what they want to see. And it's not, doesn't seem to be slowing down. And there's also a relatively strong labor market. So all in all, the Fed feels like they've supplied enough liquidity. They've put enough stimulus in the economy. It's strong enough, even with the new COVID variant. So the idea is that they're getting closer and speeding up the timeline to removing that accommodation, to changing interest rate policy and to start hiking. And so that's a big deal, right? The market does not really like that so much. I mean, the market doesn't like inflation beyond a certain level either. So that's in the long term, this will be fine. But in the short term, when a central bank changes its interest rate policy and it changes from an easy money policy to a tight money policy, interest rates they target higher interest rates. That reduces the credit that's available in the economy, which means that borrowing costs more, which means that there's less money flowing around. There's less debt being taken. There's less credit being extended, and there's corresponding diminished demand for all kinds of things, including financial assets.
Right.
And
It's
so you
about
tend to see
lack of
sell-offs, right?
money.
Yeah,
It's a lack of supply of money available. And I'm glad that you pointed that out, because there's a couple things in the article that are a little misleading. And here it says high interest rates and tighter financing conditions are designed to prevent inflation, which is right. The side effect is that they tend to hit speculative assets as investors opt for safer investments. It's not as much opting for safer investments as it is much of a drying up of the supply, the music stopping, and there are not enough chairs to sit in. It's also
right. And the reason, and you're actually right about that. I'm glad you brought that up, because the last time we did this in 2018, the safe investments of gold and bonds didn't perform that well. It was very counterintuitive. People tend to think, okay, there's a risk off sentiments occurring, right? So we're going to sell the risky assets and we're going to go into safe assets. But the weird thing is that gold and the bond market did not rally the way that would kind of imply. And in fact, those assets lost some value. Now with gold, I don't want to get into all this, but essentially the idea is that even the safe haven assets like gold and bonds, these two in an everything asset bubble, counterintuitively, even the safe plays will lose some price premium in a truly tight money regime, right? And that's because, and the reason is because those assets have been financialized as well, and they're in a bubble too. Right. And when the credit dries up, the bubble it deflates, right? And even the things that are considered to be safe are, a part of that story. And so, yeah, the reason we're kind of bringing this up is because this Barron's author of this article makes a criticism of crypto and Bitcoin and says that they don't seem to be truly alternative assets because they need to start performing as safe havens, right? To be, and instead the criticism is they're performing like speculative high growth assets like stocks. Mm-hmm. And the idea being is that they need to be going up as stocks go down, right? As a safe haven. And I feel like this is just a kind of misguided, because even gold and bonds don't perform that way. So it's like it's a standard. This Barron's author has created a standard for Bitcoin and crypto to live up to that even gold won't live up to. If you look at markets right now, gold has come down today, just like everything else. The Dow came down, the S&P came down,
right?
Crypto sold off, as we've seen, but gold did too. I mean, it didn't come down quite to the same degree as the others, but it has sold. It's in the red, right? So by this standard, it's not an alternative asset either, right? But of course, that's silly. It's yeah. So anyway, I feel like that's just a kind of a biased argument.
Arbitrary standards that really have no meaning. I mean, like you said, what's the rule book for saying it is an alternative asset? A true,
Right.
what is a
What
true,
meets that standard?
what is a
Yeah.
true alternative asset is my point. Is it is an alternative to what it exists. You can call it,
Yeah.
it's called a true alternative, make up your own word for it. But yes, it is now long run. So, okay, but the point of this
Let's
is,
take a look at the minutes, because there were some couple passages in the minutes we could talk about that kind of, I think they're going to touch on what you're about to get into,
let's do that. Let me just scroll right to
the
it.
difference between the long and the short.
Here we go. You
All
want
right.
to
Yeah.
jump
Page
into it?
2. Yeah. Top of page 2 has a, or I'm sorry, the bottom of page 2 has a really good kind of summary of what's happening here. It starts off saying, regarding the outlook for U.S. monetary policy, expectations for a reduction in policy accommodations shifted forward notably. Anytime, and if you're familiar with Fed language, anytime they say something with any kind of emphasis, like notably, that should be read as that's they always understate things. So that's a massive statement. That should be read with an exclamation mark, right?
There's a whole, there's a leak in the ship. If that means that there's a big hole.
Yeah. And it's time to, and all hell is breaking. Now, the next section that kind of jumped out at me is is on page 3, and it's in the second paragraph. And I'll just start jumping into it. It says, although the desk surveys and interest rate futures indicated expectations for earlier increases in the target range than at the time of the November meeting, expectations for the Fed funds rate at longer horizons did not appear to have risen. So the idea is that they're expecting short-term rates to go up because of the need to deal with inflation, but that long-term, the expectations for higher rates did not rise. So the idea is that we're not really imagining that we're going to see interest rate policy sustain higher, a change to where we just have ever higher rates, right? So in 10 years from now, we're looking at, a 6% Fed funds rate or something like that. Like, that's just not on the table. And so as we highlight how expectations about short-term rates have risen, we should be clear to make it clear that, hey, that long-term rates are still expected to be low, and that's not changing, right? So that should calm you a little bit into thinking that, okay, the long-term policy path is not that different. We've seen these momentary, normalization attempts on the part of the Fed. One was in 2018, not too long ago. And as there was sell-offs and there was a slightly higher rate that they had some rate hikes, but we've seen this and we know what to expect. And I think that the scope for how high rates can go is very limited because of how much debt is in the system and the more structural concerns about how many dollars exist and that whole thing. So I feel like that background is what's keeping the expectations for future rate hikes or for higher rates going forward in long run. It's keeping a lid on that because people who follow these things realize that, well, a truly strong dollar policy doesn't make sense for how many treasury debts or how much debt the treasury has. It wouldn't work. So I feel like that should calm things a little bit.
And in the long run, on top of that, when you look at alternative assets, speaking of alternative assets, when the dust settles and the market calms down and the supply returns and you've got that injection of new, what else are you going to look at? Where are the educated investors, so to speak? Where's the smart money? Where are people going to look to put their energy once they have something? Well, blockchain and crypto. I mean, these are the technologies that we see continue to add layer after layer to be more improved, to accept more and more adoption, more scalability, improvements in privacy, improvements in security, with applications that are more user-friendly with cleaner user interfaces. So in the background, you've got all this development going on those projects that are like after the 2017 ICO craze. You've got those projects that are still building out despite the downturns. And when the bull comes back and the money's there, the velocity's there, and it's moving around. There you go. Crypto blockchain, in my opinion, is going to be one of the more highly sought after markets
Right.
in the economy, and
No, I think
providing
that's right.
some of the most value to the world. And if you look for a 5 to 10 year time horizon.
Sure. Well, I
And
think we want to switch gears and kind of jump on a point that we've been meaning to talk about in a video, but we feel like that would fit perfectly in this video, talking about monetary policy and debt and all that. So recently there has been a criticism on the part of Elizabeth Warren, specifically about stablecoins, talking about how they are an inherent risk vector for the broader macroeconomy, and that potentially some oversight needed to be put on them. That there was consumer fraud issues, and there was issues with collateral, and all kinds of issues about redemption. And so many criticisms were laid on stablecoins, and they were highlighted as being a particularly risky channel for risk, and macro risk, in terms of like there being around the banks, and there being one of these projects maybe failing or not being able to redeem, and then there being some kind of cascading losses and counterparty risks, because who knows how these assets are shared, and what institutions have them on their books. And so this whole nightmare scenario was discussed, basically, where some sort of a crisis in the stablecoin market would ripple out and cascade and lead to some instability in the broader economy outside of crypto. Right? We're talking about outside of that, right? Crypto's problems spilling over into the macro economy. And I know Lucas has had a lot to say about this point, so let me let him take the floor here.
Well, we've both have, and we've got a video on the Pandora Papers, and we have a video on the Panama Papers. But was it the Pandora Papers released how many $1 trillion from a few billionaires, or how many hundreds of billions? Some
It was a large number. I don't remember.
Large number of money that was uncovered to be laundered, and so when you look at the traditional financial system, and the amount it's greater than the whole market cap of crypto, and you look at the amount of money over the last decade and 15 years that is consistently having risk and having issues where there's lack of oversight. Now, what you were just stating, we've mentioned this, we've made a video on Elizabeth Warren, and that well, she just obviously doesn't know what she's talking about. That's all. She had an idea of something in her head, and that's whatever that was what she was talking about. But the idea of being a run on Tether, she just doesn't. We've mentioned this in the video. No one ever puts Tether in their wallet and expects to go to the bank and redeem Tether for dollars.
Right.
So some idea of there being a run on Tether, and
yeah.
But that's
a category. It was a category mistake.
Really, yeah, it was category errors all over the place, and it almost was like more of someone needs to take her and just talk to her a little bit more about what blockchain and crypto and how and what these are. So it was.
Yeah, that's a good point. But I think another point to highlight is, let's just look at the market cap of stablecoin. Now we know market cap of crypto in general is over 2 trillion, so that's a large number. But looking purely at stablecoins, we're looking at around $169 billion market cap. Right?
And I wanted to bring this up and show this, because you're right, 169 billion. That's so small. And when you look at how powerful, how big many of the billionaires and many of the movers in financial markets, professionals, people who spend their life taking billions of dollars and using that to make billions of dollars more. Because if you think you're a degen in crypto and you're trying to farm and leverage and have fun making more and increasing your Satoshi stack in the world of DeFi, well, people who have been sitting on millions and billions have been enjoying increasing their stacks for a long time. And it's still going on to this day, even those that are in the space playing. So, my point to that is that it's a thin market, in that we're still young, it's still early.
Right.
There's still a lot of volatility, because it doesn't take but a few big moves to make prices go one way or the other right now.
Well, while you were talking, I Googled how big is the derivatives market. In a case you don't know what the derivatives market is, this deals with these are bets, side bets on virtually any kind of investment, like whether it's stocks or commodities, bonds, currencies. There's derivatives traded on all these products, right?
Right.
And this whole market is considered to be the shadow banking system because it has a lot of entities in it that perform bank-like functions, but aren't actually considered to be banks, right? So regardless, the overall market is said to be worth around $1 quadrillion on the high end. And now other estimates have put it around 640 trillion. And there's about 12 trillion in underlying collateral and backing up this notional value of these derivatives. Now, if you're curious what's going on here, well, you might remember during the 2007 housing crisis, when the whole housing market crisis started, there was a seizing up of markets in the credit markets, in the short-term lending markets. And I think it was commercial, I believe it was the commercial paper markets. This is where companies will issue short-term bonds to basically borrow money. And these markets seized up. There's a lack of liquidity. Well, these markets are part of this shadow banking system, right? So a lot of the liquidity that gets put, it's in there to buy these assets is really created through pledging other assets as collateral many times over. And you pledge the same asset for many different loans, and what's called rehypothecation, and you end up ballooning this underlying collateral into like a notional value of many times more of having all this purchasing power that really was phantom. and so when these underlying assets have an issue, whether there's like a loan that doesn't get paid and a write-off that happens, well, the fact that asset was used and pledged as collateral many times means that the chain of credit that was tied to that asset gets reduced and can be, and that destroys credit. Essentially, it's very deflationary. So the ability to inflate these massive bubbles has with it this implicit instability and fragility, because those bubbles can collapse very fast too, because they're based on collateralized loans, and that value of those loans is very volatile. And because these assets have been pledged many times over, the risk becomes systemic. And so I just bring this up to say, if we're going to be worried about regulating stable coins because of their inherent volatility and how much that could ripple out and affect the broader economy, how is it we're not looking at this 640 trillion shadow banking system and the way that it's used and the mechanisms in it are used to conjure up phantom liquidity and phantom value and phantom wealth
and
at a level that
would, and to seize it, and when it does, it takes away the real estate and the assets of those who can
of real people
who can no longer afford to service the debts, and so they get serviced instead with
but we're worried about Tether, one of the most over collateralized projects in crypto.
Yeah, the derivative market, like you said, I mean, in this graph, it's notional value 558.5 trillion.
Yeah.
Low. That's the low end.
That's the low end. Yeah.
And here we are. So if anyone ever says, if you ever hear someone say, I heard a stable coin, I mean, any one of these or all of them put together, none of them do anything.
Like a fart in the wind, man.
It does, none of it does anything to pose a risk to any economy anywhere in the world. It does. It's like it's carnival. It's child's play compared to the market at large. That being said, what's so beautiful about this young and early, even you look at Bitcoin and the altcoins, the market cap, the technology, when you realize the moral hazard, and we look at the Panama Papers, the Pandora Papers, the stuff that Elizabeth Warren's not talking about, the stuff that while you're talking about this little tiny $108 billion, there's this quadrillion, there's this $1 trillion stuff that you're in charge of. You're actually in charge of regulating it, of monitoring it, making sure that certain people with access to enormous amounts of wealth or political power aren't gaming the system. And there's all these papers came out saying, wait, they're
They're gaming the system.
And it's been going on for a long time. And we've got Panama papers, Pandora papers.
Yeah.
I mean, who knows what the next papers. And these papers are just people saying, we've spent a decade with like hundreds of people pouring through these papers, and this is what we were able to come up with. There's a lot of stuff out there that hasn't been
Nobody knows. Yeah.
that nobody knows about. That's not it. So, what's funny is that crypto and blockchain, sure, there are some rug pulls. There are things that are not as decentralized as others. There are projects that are more risky.
There's manipulation and front running.
But the overall technology that is built on, the people that go in are aware of many of these risks, hoping that certain DAOs get developed or certain treasuries get stacked in the long run. And they're built on decentralized, secure protocols that.
And I'd say one more thing. There's a mechanism which is pushing innovation. We're even looking at Secret Network, the IBC. I mean, Secret Network is creating an infrastructure for NFTs that makes front running an MEV impossible, right? When was the last time we saw something similar happen in the regulated normal financial system, where the incentives there are different? It's more like a crony capture market where the consumer is not, and their needs are not really the forefront, right? It's more about serving institutional needs. So I feel like crypto, at least, it's not perfect. There's problems. It's an unfinished project, but we're on the right path. At least we're on a path that's going in a good direction. And I think that can't be always said for the kind of markets that Elizabeth Warren and the SEC are connected to. In fact, you can almost make the argument that the opposite's the case. That's a different video.
Robinhood, Citadel, we've talked about it. It's now the whole world. It's already always been known about, but front running and order flow. I mean,
paying for order flow, all that. Yeah.
It's a way of doing business. So for us as human beings, men and women, mankind all around the world, being able to create ways to transfer value without having these inefficiencies, without having these sinks, without having this front running, that's a good thing.
It's good work.
It's a harmonious solution.
Well done, humanity.
Well done. Well done. Thank you. Thank you, God. Thank you on the shoulders of the giants that stood before us, because that's really how blockchain and any technology works. We're all just taking that a little bit further and a little bit further and building, and it's still early in just building. So you know what to do if you like this kind of information. I think that pretty much sums up. I mean, we'll leave these links below. Do your own research to be your own bank. That being said, this beginning of what could be a bear market, this could last. These things could last. Supply chain issues can pop up, and the reality is, when you look at how small and thin the crypto market is compared to the world market at large, when there's a hurt going on, there's a hurt going on. And in the short run, it's going to be felt no matter where you are, you're going to feel it. But when the dust settles, where would you like to be and where would you like to be ready? In my opinion, make sure you're staying on top of the developments. One thing, if I've learned anything in my time in crypto, it's that when the bear market comes, whether it's a few weeks, a few months, or a few years, that's the time to stay diligent and continue reading up and finding out what are those blockchains and cryptos still building. What are they doing?
And participate too. That's the time to go and get into some of those projects that you've been wanting, or that are just now announcing that are doing cool things. Don't just jump out of it. Keep in it, because that's when things will go on sale. And also you can see which projects are continuing to develop, and you'll see where the value is going to be at going forward.
And be ready for a wild ride up or down, because that's just the nature of the crypto markets. That when they say volatile, they mean volatile. But before we started filming this video, you mentioned something, and on the way out, I think it'd be a point to mention it again. Like, this is not financial advice, like we said, and I like to kind of doom and gloom, worst case scenario, although hope for the best. And you brought up a good point, and that's that there's also that news of the reverse cat bounce. There's that blip, that shakeout, where people are having second thoughts and doubts often right before a good growth cycle.
Right. Yeah, that's true.
Right. And so I think that whether or not that little blip takes a week or a month or however much time, I feel strongly that when you look at the macro outlook, look at where we're at today from where we were at in 2017 or 18 or 19. Look at how many more fiat on ramps. Shucks, Secret Network just released a fiat on ramp where you can now take a credit card or debit card and you can go directly and you can purchase Secret. And there are other cryptos that do that. There are more fiat gateways right here, buy, convert. So it's been made easy for people to onboard. It's easier for adoption. That's my point. And when it's easier for adoption and there are more people with wallets, when the supply chain starts moving, when the velocity comes back, when the liquidity comes back, where would you like to be when it comes to the markets at large? And in my opinion, not financial advice, where I have been and where I will continue to be, and look forward to sharing that. So long as that works out for all of us, is the blockchain and crypto markets for many reasons, and the least of which financial freedom, freedom of movement. There are cryptos out there that are actually working to bring charity and awareness to global problems, to make the world a better place. So we look forward to sharing those developments as well.
Yeah, well, follow, like, subscribe, comment, whatever you feel compelled to do. We love the participation. There's things we haven't touched on that we don't know about or that we got wrong. So by all means, let us know. We will try to do better. And if you like it, continue with this journey. We will be making more videos. We will be covering everything that we can secret. I can promise you that. And in the IBC. So we'll see you.
Until the next time, have a beautiful day and namaste, y'all.